Welcome to OmniTalk, powered by NXTsoft. I'm your host, Amy Rice, and OmniTalk is a podcast focusing on fintech and how it affects banks and credit unions. On today's episode, we'll be talking to Tom Parsons and Dave Hynds about the importance of stress testing for financial institutions. Today I have Tom Parsons and Dave Hynds on the phone with me. How are you guys doing?
Great, thank you.
Fine, doing well. Thanks.
Thank you for taking the time out of your busy days to chat with us. I wanted to go ahead and start talking about stress testing. You often refer to low profitability, high impact events. Can you explain what that means to a banker?
Sure. Let me start with that, if you don't mind, Dave. And before we get to the high impact events, you really even need to start further back in what I call a baseline, or what we would refer to as a business as usual plan, because if you look at a stress event, you have to compare it to something. So we got to start at zero. And there are a couple of different ways to ultimately measure against that baseline, depending upon what baseline you use. One baseline might be a static balance sheet. Nothing grows or declines over the next 12 months. And if everything kind of stayed the same, what would my income look like over that 12 months? And so what we're trying to determine is what the change in income is based upon some event. Another way to start with a baseline is a forecasted balance sheet. And I want to also make a distinction here that a forecast is not a budget, because I do talk with bankers and they'll say, well, I have a budget. Can I compare to that? No, because usually you make a budget for 12 months and by the end of January, it's out of whack. It's not going to actually come to fruition. So maybe just starting with good principled practices of creating a baseline and updating that baseline or business as usual plan on a regular basis, and then measuring against those events is where we want to start. So what would be a low probability, high impact event? What does that mean? Well, what we want to do is introduce some variables that create a situation that is really unlikely to happen in most situations. But if it did, would create havoc with the balance sheet, with the income statement. So that's what we call low probability, high impact event. And we're kind of living through that right now. The thing is, though, we want to have taken a look at that before it happens. In other words, we need to anticipate and play what if and say, well, let's think of things that could happen based upon what we know from history. 10 years ago, we were looking back and thinking, wow, we should have seen the mortgage bubble coming. And we didn't test for that. 10 years ago, maybe we should have looked forward and said, well, what if there was an epidemic? What if there's a COVID-19? How would the markets react, and how would our income change over the next 12 months if those circumstances were to take place? So that's what I mean by high impact events and low probability. Dave, if you'd like to add to that, feel free.
Yeah, I mean, since you're going back to the beginning, what I like to think about is that stress testing is not something that's just for financial institutions. Stress testing happens in a lot of industries. What used to happen when you would buy a house is that sometimes the home inspector would turn on every faucet all at once to make sure your plumbing system could handle it. That's a stress test. Another stress test is if you have a computer system and you do a simulation where you have a lot of people start bombarding your site to see what they can do until it breaks, basically. That's a stress test. So that's the same thing that we're trying to do with banks. Tom's talking about there on the balance sheet. I also work a lot with stress testing of loans, and we're trying to do the same thing where we're trying to say, how much can we throw at this until we have problems with our loans? So it's, as Tom mentioned, we try to look at low probability but high impact. But I also like along the way to look at kind of what could happen in the next 12 to 18 months. We encourage people to stress test where they look at where they're at right now, look at what feasibly could happen in the next 12 to 18 months, and then look at that gigantic, what if all hell broke loose? That's kind of the worst case scenario that we also want to model just in case.
Stress testing can cover a large range of topics. What, if any, are a priority?
Let's take it back again 10 years ago when we had the mortgage bubble. The joint agencies released a policy statement on interest rate risk and liquidity at that time. They actually didn't release it. They kind of they restated something that was already written from back in 1996. And what it said was to introduce a lot of different variables to measure what the impact on income change is going to be. And let me give you, for instance, it reiterated something that I think a lot of bankers had forgotten about, is that if you wanted to get into a new line of business, offer a new product line, for instance, maybe you weren't making construction loans, and you wanted to get into that, and let's talk maybe not so much retail or housing type constructions, but maybe more commercial type construction. What they want you to do is introduce what-if scenarios that tell you what that is going to do to the balance sheet and income statement if you were to get into that business. What's your growth in that business? What's your cost of funds as you get into that business? How's that going to impact what you pay on deposits and charge on other loans in order to balance out it's really the balance sheet is just what it's described. It's a balancing act between assets and liabilities, charging the right amount of interest on your loans, but also then managing how much you pay on deposits and other sources in order to fund those loans. So stress events aren't necessarily natural disasters, although they could be. They might also be things like layoffs regionally, strikes, labor strikes, things like that. So things like natural events or regional political events, or even just new lines of business are different types of categories that need to be tested in order to determine at least what would happen against the baseline plan should these events take place.
Now, the nice thing is actually the OCC in particular has given us a little bit more definition on the loan side of stress testing. They have come up with their own program on how to stress test commercial real estate loans. And they did that because of the impact that those loans have on the overall marketplace. I don't recall the exact number, but it is a huge amount of the overall portfolio of all banks that are tied to commercial real estate. So a downfall in that area can lead to a big problem system-wide. Now, what they have not gone into is they haven't gone into breaking down into other areas. They haven't gone into construction loans. They haven't gone into C&I loans or other types of consumer loans, cash flow dependent loans. So we do have more specific guidance on the loan side, which is nice. But that I don't think that the guidance that they give us is really putting us in a box saying we only want to stress test on our CRE loans. They're still saying we need to stress test. We need to know what our loan portfolios are looking like across the board. But we do want to focus a little bit on the commercial real estate portfolios. So that is, I think, one of the nicest things that the regulators have done for us. They typically don't give us specific guidance, but on commercial real estate, they have given us a specific method of how to do that stress testing.
The first release of the policy statement on interest risk rate was in 1996. Is it still relevant, and what's changed?
I alluded to it a moment ago when I mentioned the joint policy statement. It really came out in 1996, and even before that, bankers were required to perform some stress evaluation. It's kind of evolved as a practice. Back when I was doing it myself with computer technology, it was many years ago, but we would produce the results. It would take a long time. We were performing what's called the TB13 test, which was rate shocks. And it came out of something that Thrift Bulletin 13 back in the 80s had recommended. But anyway, a lot of bankers were subscribing to services and buying application software and installing it and getting trained and getting this massive amount of data and putting it through these tests. And then the information would come out in the form of reports and kind of sit on the shelf, and nobody did anything with it. And so I think that's why the joint agencies came out with this policy statement in 1996, is to really stress the the notion that you would have to be doing this. So over time, this has kind of evolved. Then it gained more acceptance, but then the examiners came in and said, well, you can't just produce the results. You actually have to kind of look at it. And so now bankers are required to actually produce the results and show it to the examiners and prove to them that they were doing it. And then a little bit later, the examiners came back and said, well, now I want you to understand it and explain it. And so that's where we kind of come in, because as producers of software and service that provide stress testing, now we've become educators. And what we do is help bankers, both banks and credit unions, thrifts as well, in the process of understanding and explaining the results to their board, to their examiners, because if they're unable to do that, that's when they start to get into trouble. I think the last piece is really, what do you do with the information? You can explain the results, but then how do you act on it? And that's, again, where the examiner is stepping in and saying, well, if you see something, then do something, so to speak. It's kind of overused these days, but that's exactly what they want you to do. They want you to anticipate change and then be ready for it in the form of a contingency plan. And that gets into another podcast, is how to then put together plans that take you through an event if the event occurs. Dave, do you have anything to add to that?
Yeah, one thing to touch on here is that on the loan side, it's really been a progressing field where the OCC did give us guidance and told us what they want, and they even supplied a spreadsheet, which is great. However, they supplied a spreadsheet so that you can input one loan at a time. If you have a portfolio of 1,000 loans, you probably don't want to hire someone to sit there and run that model 1,000 times with each of your different loans. It's just not really reasonable. So while we have the basics of how the calculation should work and how the different numbers should interact in the stresses themselves, we didn't have a database type setup, initially to go with that. And we didn't then have the ability to track that over time. It was a one-shot deal. We have our data. Let's input it into the spreadsheet. Here are the results. Put it in the file. So I think we've come a long way on that side, in that we do have databases now. We are tracking the data over time, seeing how things are changing. And most importantly, what I love to tell customers when they ask me what's the most important thing I can do when I stress test, is act upon the results. They can't just say, here, we ran a stress test, I'll print it out or I'll email it to you. The regulators nowadays want to see you run that stress test and then look at the results and say, well, look, we have a potential issue here, so we are taking steps A, B, and C to try to mitigate our risks according to that. We have to be proactive these days. Now that we have data available to us, we need to use that data and try to get ahead of any potential problems. That's really the point of stress testing.
What if a financial institution doesn't have the resources to keep up with the requirements or technology?
I'm encountering that a lot lately, and it kind of goes back to what I was starting to mention before I turn it over to Dave, is that the requirements from the examiners have become, should back up and say the scrutiny by the examiners and the requirements that they want out of stress testing is become limiting to a banker, because they have to learn more and then they have to do more. And they've gotten to the point where they've just kind of thrown up their hands and said, enough, I just want someone else to do it for me. And that's where we'd like to step in as educators, but now also as what you might even call the risk arm, not all risk, but at least interest rate risk and liquidity risk and credit risk arm of a financial institution. Outsourcing is the next level of this, is to say that we're going to hire you as our virtual ALM expert. And that's a direction we're headed, and we can certainly do provide those kinds of services to our clients.
Tom, Dave, I appreciate you taking the time to share your knowledge about stress testing.
Well, thank you, Amy. We enjoyed it.
Thank you.
If you would like more information on NXTsoft stress testing solutions, visit nxtsoft.com. Thanks for listening. Stay safe and stay well.